Hey everyone, and welcome back to the channel. Today, we are diving into a topic many of you have faced: managing options positions. When your underlying assets are caught in a furious, almost parabolic surge, it's exhilarating, terrifying, and can make or break your portfolio. Recently, I've made critical adjustments to my positions in SLV, SNDK, and MU. All three were on an absolute tear, challenging my original short call positions. My goal wasn't to fight the trend directly. Instead, it was to buy time, to weather this parabolic storm and position myself for the eventual cool down. Let's look at what I did. I executed a series of rolls. This isn't just closing a losing trade and opening a new one. It's a strategic maneuver where you close your existing short option and simultaneously open a new one further out in time, at a higher strike price. First, SLV, silver. My original short call was under pressure as silver prices began their aggressive climb. To manage this, I executed a diagonal spread. I bought an August 2026 $120 call and sold a December 2026 $140 call. This roll came at a small debit of 55 cents per contract. Why did I do this? I essentially paid a small amount to push my ceiling. From wherever my previous short call was, all the way up to $140, and gave myself until December 2026 for that short call to expire. I'm betting that while silver might surge in the short term, that extreme upward momentum won't sustain itself all the way to $140 by December 2026. This move bought me precious time, moving my risk further away, giving the underlying asset room to breathe. Next, Micron Technology, MU. MU has been an absolute rocket, and I had several short call positions that were deeply challenged. Here, I performed two separate diagonal rolls. The first involved buying a June 2026 $700 call and selling a September 2026 $800 call. Crucially, I received a credit of $7.37 for this roll. The second was buying a June 2026 $540 call and selling a September 2026 $640 call, for which I received another credit of $2.45. These credits are key. Not only did I move my short strike prices significantly higher, up to $640 and $800 respectively, but I actually got paid to do it. This effectively lowers my overall cost basis on these positions and gives me a much wider buffer against MU's continued ascent. I'm giving MU ample space to run, trusting that by September 2026, those extremely high strike prices will be out of reach, or at least that the extreme implied volatility will have subsided. Finally, SNDK, or Western Digital. This one was perhaps the most aggressive surge of the three. My original short call here was also heavily threatened. I rolled it into a reverse calendar spread. I bought an April 2026 $760 call and sold a June 2026 $760 call. And for this move, I pocketed a massive $29.33 credit, receiving nearly $30 per contract to push my expiration out and adjust my position is phenomenal. The goal here is similar. Use that hefty credit to absorb any further short-term volatility and wait for the parabolic fatigue to set in. By June 2026, I anticipate that the irrational exuberance will have faded, allowing me to close the position profitably or manage it further. So, what's the underlying thesis here? It's all about implied volatility. 4. During these wild, parabolic surges, the demand for options skyrockets, especially out-of-the-money calls. This inflates their premiums dramatically. My strategy is to recognize that while the stock price is indeed rising, a significant portion of that premium in my short calls is pure for. My hope is that once these parabolic moves exhaust themselves, and the stocks consolidate or even pull back slightly, that inflated implied volatility will come crashing down. This volatility crush will cause premiums to drop, much faster than they would simply due to time decay or modest price movements. If that happens, I can potentially close these rolled positions much earlier than their 2026 expiration dates, locking in profits from the collected credits and the subsequent contraction. It's a high-stakes game, but by rolling to higher strikes and longer dates, especially for a credit, I've transformed potential unlimited risk into a much more defined and manageable situation, all while giving myself the time needed for the market to normalize.